Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
The one thing that I just want to add to that, and you did hit the nail on the head with respect to uncharted territory. I referenced this area in here as being a very key area. So the thing is, we cannot really take any sort of a directional move here until we see how our prices trade in here. If we see some consolidation and all of a sudden a little peak above that, well, then that's showing us that, hey, you know what, possibility that this thing wants to go higher. But if we just keep in mind that this rejected off of a high to trade back down at the 160, right, then as we break back into this zone, this is where we can say, you know what, maybe for the next month we're going to see a little bit of backfilling here. Why don't I try to take advantage of buying some puts or a put spread as this thing not to say that bigger picture it can't go up, but shorter term, if you're looking to make a couple of dollars, if the technicals are telling you that story, then look, step back, shed your directional bias and say, all right, let's take advantage of this in the other direction for a short period, even if the big picture may be a continuation to the upside. But here we need to see some decision making. Right, and that's I think that in the bigger picture, that's what I'm seeing now with all of these pair values, in the sense that we've had such significant runs, just as we saw this move here and this kind of consolidation here. Okay, you're going to get that at certain points. The market's going to stop and catch its breath. And again, go back to our previous market outlooks, and you'll see that it generally takes place in a lot of these key focal areas. I mean, it's just simply based on historical support and resistance levels and some key measured moves and so on and so forth. And this is how we're forecasting these targets when and if prices break out towards them. Okay, so
another interesting point too is that correlations don't hold forever, but the Australian dollar has been correlating pretty strongly with a lot of the commodity stocks. So for those of you that are listening from Australia, you understand this. For those of you in Canada, you probably also understand this, as a lot of Canadians are watching a lot of the fertilizer stocks, some of the oil stocks that are not integrated, because those are going to move. When crude's moving one way, they're going to move, of course, up, if you're long it, and then recently down. So if you have assets in your portfolio that you're seeing drop each and every day, well, the Australian dollar is pretty much correlated with a lot of those assets. Yeah. So this could help you also maybe figure out what to do with your portfolio. I know we're pretty late in this game, but we don't know how much further the Australian dollar is going to go or the crude oil is going to drop, but we'll have to see how that all plays out.
Well, you know what, and just to comment on that as well with respect to sort of a bigger picture approach, we are late in this game. I mean, we have had an unbelievable, I shouldn't say unbelievable because, again, anything is possible, and it really isn't unbelievable if you think about what led to this particular scenario here in the overall markets. But the idea is that what you can do is learn from that and step back and say, okay, if these are the things that I've seen happen, how now can I position myself to take advantage when the market, finally the dust settles and certain things are worked through? How can I take advantage of what I now understand? And that's what trading and investing is all about. Is again, I mean, it's about being able to adapt and change your outlook, admit that you're wrong when you're wrong, and go in and just adapt your approach to make sure that you don't lose any more capital or that you position yourself where you can start recouping some of that by taking advantage of some of these different things that are happening. So
exactly. Famous quote from John Maynard Keynes: "When the facts change, I change my mind."
Yeah,
I guess And that makes sense, right? What he said many years ago is that, yeah, he has opinions, but he has an open mind, and if things change, he could quite possibly change his mind. That's trading.
Yeah, absolutely. So I'm just going to real quickly, we talked about how can you take advantage, or how can you help offset some of the cost of these extremely expensive options based on the volatility. Well, you can use a combination such as a debit spread. And what that's going to allow you to do is it's going to allow you to lower the cost of your initial trade. And again, some of you may be familiar with this type of approach. We talked about it on Wednesday. But because we're discussing the whole concept of volatility and recognizing that volatility increases the cost of us participating, we can use that volatility to our advantage to a certain extent by having somebody else help pay for that. Okay? And how we do that is by creating a spread of some sort, whether it's a bull call spread or a bear put spread, but it's going to lower the initial cost of our trade. It's going to limit our risk exposure, because obviously this market can move in any direction, and by limiting our risk exposure, okay, or by lowering the cost of our trade, we limit our risk exposure. We put ourselves in a situation where we're having somebody else shoulder some of that risk for us. Okay? We could take advantage of and offset the option volatility that we're seeing here by being both a buyer and a seller at the same time. So two types of spreads that we might look at. We'd look at a bull call spread where we'd buy a call and sell the higher strike to lower our risk exposure. Well, how can you use our market outlook? Well, for example, let's say that you took a directional bias on the AUX. And again, this is not a recommendation, but just just an illustration. And it did break above that key level that we were suggesting in and around that 165. And you said, okay, well, options are extremely expensive. I'm looking out into the future, and I see it the next probable area of resistance in and around that 175 to 180. Well, you could then look at it and say, all right, well, why don't I try to catch that move, recognizing that as it trades into that higher level, we may run the risk of it turning around and going against us. So if we don't anticipate it over the next month or so or 2 months going any higher than that, we can sell off those calls, and that will help pay for our the calls that we bought at the lower strike. Okay, so, and it's going to help lower our risk exposure.
I mean, I hope that everybody's remembering the slides that I showed about the volatility and how, it seems like it's so complicated because now you have to worry about buying this option and the implied and the historic and all that. What Jason's saying is it's just simple. You buy one option, sell another, you're reducing your cost of your spread, and you're also, not only that, but you're reducing the complexity of your volatility risk.
Exactly.
By doing this call spread if you're bullish. It's just that simple.
Yep.
Perfectly put, Jace.
And conversely, if you anticipate a move to the downside, as we were looking at the AUX there, and we said, okay, well, if it doesn't break out of this zone, we may see a retracement back into that support level that I identified. Well, if you felt that over the next month or so that was going to play out, and you didn't anticipate a drop any further than that key support level, well, you can create a bear put spread. You could buy that put at that higher strike and sell that lower strike to reduce that risk exposure. Again, inadvertently or maybe even unknowingly or unwittingly, what you're doing is you're offsetting the volatility cost, or that high volatility that's baked into that premium. So you're inadvertently putting the option Greeks to work for you just by creating this spread, because you're offsetting that volatility by selling that higher call or that lower put. Okay, so you're taking advantage of that high volatility, and you're having somebody else shoulder some of the risk for you at the same time. Okay, so we actually had an example on Wednesday. So these prices are based on Wednesday's prices, so you'll have to forgive me in that respect, whereby we were looking at the AUX trading in that 152 or 150 level, and that's where we were suggesting if it breaks up, look for a play into the 160 zone, and if it breaks down, so on and so forth. So we created a spread based on the idea that if prices broke out, we'd likely see a resistance up in at the 160, which is indeed what we're actually seeing right now to a certain extent.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.